Okay. All right. So why do you, I mean, this is fundamental principles of accounting. All right. We just wanted to get the core items in accounting and financial reporting. Who are the stakeholders of accounting? All right. Whether you're an owner, the management, or the employees are basically the internal stakeholders who are interested in the financial reports of the company. External stakeholders, government, tax department, you have investors into your company, or your partnership. Normally partners are investors, but if you're talking about any other company, there'll be investors, shareholders. Banks are interested, the lenders, suppliers, NGOs, industries, association, rating agencies, right? RAM and whatever, researchers, and you got e-talks and all these kind of areas. Everybody is interested in financial reporting. The extent, how much you're going to be preparing it, what is the depth you're going to get into is depending on your size of a company. The difference will be if you're a Sendirian Berhad, you'll be just following the standard requirements by the registrar of companies. But if you're a listed company, you've got a hell of a lot of disclosure requirements, and so much to put it in the public domain, in the newspaper and everything, to publish all your results with so much of disclosure requirements, okay? Because you are being funded by public money. So these are the users of account, financials.
And
Okay.
Nakulan, is there a different type of reporting for internal and external stakeholders?
Yes. Internal, normally what they do is, see, for instance, internal accounts are known as management accounts. When it comes to being audited and being reported and being filed with the registrar company, you call it statutory accounts. So management accounts have so much of details in it because you want to make business decisions within the company. You have a hell of a lot of details. But when it comes to statutory accounts, there is the minimum disclosure requirements to meet. You won't get into the very details of it because it's very internal and it might be very confidential to the company. So they might, certain expenses which you have, maybe you got 20 line items of those detail of the expenses. But in statutory account, all of them will be grouped up and called as admin expenses. What is the real breakdown? You only get in management account. So you'll see a difference between, for management reporting, it is more detailed, more for the use of decision making. Statutory accounts is because you've got to file it, and that's what your auditors want to be reporting to. Module 2, you'll get into to look at financial statements, explain what a balance sheet is, how do you construct a balance sheet, what is the income statement and statement of cash flow, which we saw earlier, what is the purpose, what are the elements, what is the structure, what is the way you prepare and report it, how does the balance sheet work along with the accounting equation we saw. The equation we saw was assets equal to liabilities plus equity. So what is equity equals?
Asset minus liability.
Yay, that's right. All right, that's the accounting equation, how it works. Okay, so define what are assets, liabilities, equity, how are they related? Differentiate between income and cash flow. I told you that earlier. So remember when we looked at the preparation of accounts, we used the revenue recognition method. You will invoice your client. When you invoice your client, you recognize it as an income in your business, irrespective when your client pays the money.
I don't understand how a liability becomes an asset. Earlier one, right? You said that it's liability plus equity equals asset. How does a liability become an asset?
Let's put a number to it. Say your asset is 5. Liability is 3, equity is 2. Okay, the equation, fundamental equation. If your asset is 5, your liability is 3, and your equity is 2. Asset minus liability, which is asset is 5 minus liability 3 equals to 2, which is your equity.
Okay, so can we put it in slightly more concrete terms? I put 100,000 into my business.
Correct. That's going into equity.
I have bought a bunch of furniture which I need to pay for, say 50,000.
Okay, how did you buy it?
I'm going to pay cash for it.
So what happens? You got cash, you brought 100,000 in cash, capital goes up, your asset also would have gone up by 100,000. Now what happens is you're going to take the cash and convert it into furniture. So 50,000 goes down in your asset, which is cash, and 50,000 goes up in asset, which is your furniture. No impact on liability, yes. If you have bought the furniture for 50,000 without paying for cash, but took a you took a credit from your creditor for 60 days payment, so it will increase your liability.
So I got 50,000, which is like I'm refurbishing my office and I've spent 50,000 on this and I will pay this to my contractor in 6 months' time. So I've got a $50,000 liability.
Correct.
Some of that might convert to an asset in the form of furniture, but some of it might just be, stuff. My liability would be 50,000 then.
Correct.
Would that bring my asset down to 50,000?
No, your asset went up because you bought furniture for how much?
So the services would be...
Services is not an asset. If you have bought the furniture, furniture is an asset. If you buy services and pay for services, it's an expense. It would have dropped your equity.
Let's say I'm not buying furniture, right? Let's say I hired a consultant to do a report on something, and so I'm paying him 50,000. Then I've got a $50,000 liability.
Yeah, so your liability will go up, your equity will go down because you'll charge the consulting fees as an expense to your income statement.
And my asset still remains at 100,000.
Your asset will remain at 100,000. Your liability, you're not paid the guy yet. Your liability will go up and your equity will come down. A balancing game which is taking place here, all right? So the impact is on liability. So you're funding your company with more liability by charging off that against your capital. Your capital will come down as an expense.
Will the report be considered an asset?
It's an expense. What are the types of financial statements, all right, which we looked at earlier? We just briefly went through. One is the income statement, which is typically called a profit and loss account. Then you have a balance sheet and your cash flow statement, all right? So it is basically balance sheet shows your net worth or what is your financial state of affairs or your financial health of your company or your business. Income statement shows you whether you are profitable or not profitable. And your cash flow statement shows you where the monies came from and how the monies were spent in your business. So it typically tells you the story. So income statement, all right, which is known as a profit and loss statement, it is for a period of time, all right? It is for a period of time. It could be for 6 months, 3 months. Generally, all financial statements normally which you're going to be lodging with the registrar companies or whatever, it is for the period of 12 months. A calendar period normally is being used because Malaysia uses a tax calendar period. Countries like UK, their fiscal year is from 1st April to 31st March. And most companies also do their accounting in the similar way. But in Malaysia, it's generally calendar period. This is where you record all your expenses, your revenue to see whether you get a profit. So it shows you your total income, your revenues. Sometimes they call it turnover. Turnover is another name for sales. Sales of business is known as turnover. Less cost incurred in making those sales. Why they are saying incurred in making those sales? Because it follows the matching principle of revenue should be matched against those expenses which were incurred to generate that revenue, right? So that's cost. So this is generally what happens when you prepare a P&L account. Income statement follows standard things, revenue, expenses. Expenses could be generally what happens in, this is for companies who are selling products, who generate revenue by selling products or whatever. That's known as cost of goods sold, all right? Those are expenses. You will have, if you're funding your business by loans or overdraft, you will have interest expense to pay to the bank. And then you got selling expenses, a lot of selling expenses, general administrative expenses, which could fall into salaries, rentals, stationery, and the whole works of it. So once you get that, and then you'll come to something known as a depreciation expense. I will explain it separately. Bear with me for now. All right, what is a depreciation? We will look at that. And then you got income tax to pay. That is also an expense in your profit and loss statement. All right. So these are generally the type of expenses. And then you derive whether it's profits. Profits come in different form at different stages. The first calculation of profit, you compute your profit margin, which is your gross profit margin, the raw gross profit, which you derive from your business, all right? And then you have net operating income, normally is known as EBIT, interest before income, earnings before interest and tax. And then you have earnings before tax, that is known as EBT, all right? Generally, this is the corporate terms which are being used. In a business, like in your partnership, in your law firm, it will be very straightforward. You got fees, and then you got lots of expenses which are related to generate the income down here, and then you got income tax or whatever, you have some, you derive some interest, you pay for some interest expense if you are funding your businesses. Typically, which is your biggest cost in your law firm? Which is your biggest cost? Partner salary
And rental and things like that.
rental, yeah, and then you got your associates who work for you or whoever, you got to pay those things. Any other big expenses which you incur typically in a law firm other than salaries and rental?
What about loans that you take?
If you take loans, you pay interest on loans. That is an expense. When you take a loan, it comes as a liability to your business. When you take up that liability, to fund that loan, you got to pay interest. That interest expense is charged to your profit statement. So the elements include revenues and gains. So as an income, you have fees which you receive from your client, you earn from your clients. Sometimes what happens is there are certain income you get in your business which is not coming from your normal ordinary activities, because your core of your business is to provide legal advice and charge your clients with legal fees. But sometimes you've got certain other kind of gains which you could take place in your business. If you have a property which is your business property, if you sell the property and make a gain, that becomes a gain to the business. I'm talking about business property, not your personal property, your business property, and that becomes a gain. And it is also recorded as an income, but it is not from ordinary activities, because your normal activities is to charge clients with fees for legal advice. So you have, what are the different types of revenue? You could have sales, fees. You could place a lot of fixed deposits in the bank and earning interest revenue, or you could have bought shares in certain companies if you are allowed to in your business practice, and you will probably receive dividend revenue. Or in the case your business property, part of your property is being rented out to some other tenants, some other using part of your business property. If you receive rent, these are all incomes in your income stream in your company.
What about if, like, say the property is my own property? Say I'm using my house as my law firm. How would that work? Assuming there's some rental or whatever, it's my own house.
So if you have your own house, it'll be tough to show any kind of rental expense because you don't have it as a rental. The only thing you can figure out of taking some cost which could be in lieu of your business which you're running is you may take some of your electricity cost and charge it out as an expense as part of the sharing. All right, you need to have some kind of a basis in case you get questioned by the revenue. So those kind of expenses, water bills and all those things. Whether you want to charge anything for your house, even though you probably have your house under mortgage and you must be paying interest expense to the mortgage, but I don't think they will allow you to charge that because it is a personal residence, despite the fact you're using. So you may want to find other ways of taking any of those expenses which are related to your property where you are using, and how much of that amount of electricity bill, water bills, all right, which could be appropriately charged to your as an expense in your business.
But Nakulan, the house is rented.
If it is rented, Mira, you can charge the rental, part of the rental, but the revenue will ask you, is your house fully used as an office or are you sleeping there? So you need to be
it's partial because
partial. You got to make some decision on how to allocate part of the house as part of your business premises. Say you're paying $10,000 rent, and say part out of the whole property, 1/3 of it is being used as part of your business, and the rest of it is your personal housing. So you probably take 1/3 of your 10,000 and charge it out as an expense. That's the only way you got to justify all these things. It is going to be quite a common thing as people start working from home. There's more stuff which is going to come, and the revenue is going to be seeking for more information in this area.
My question is, okay, I have my own place. I work out of my own place. I own my place. I don't have a mortgage on it anymore or whatever.
Okay.
However, I pay maintenance fee because I live in an apartment.
Okay.
Can I apportion 1/3 of that maintenance fee?
Yes, you can. That's why anything which is related to your housing, electricity, water, and all these things, you provide justification of how much is the basis of allocation, and you can allocate it. Even if you run from your home now, you got, I do a lot of printing, I use a lot of printing, toner, ink, and all those type of things. You can take it as a business expense altogether, all those things, because you don't go to office anymore. And the amount of consumption of air conditioned electricity goes sky high now. Okay, so all these things, you got to collect bills like this and keep it, because these are all related to the work from home kind of situation now. The next thing is, in the income statement, there are expenses, which includes both expenses and losses. Typically, you have those expenses, which is ordinary activities, your business, your rental, your payment, your expenses related to your counsel and your partner's salaries and all those kind of typical expenses there. Sometimes you might have certain losses which comes about not from ordinary activities. Like the example I gave you earlier, if you have a business property, you sold it and you made a gain, it comes as an income. If you made a loss, it will come as a loss, because your sale of your property is not a normal activity in your business. You are not in the business of selling property, but you're in the business of giving legal advice. All right, that is ordinary activity. That is, losses may be from those kind of things. So typically in your expense account, you'll have cost of goods sold, which is for those companies which make products and sell products, depreciation expense, which I'll come to it, interest expense when you take loans for your business, rent expense, and salary expense. This is not exhaustive, guys. All right, I'm just giving you a kind of some of the key items which as a charge in the business as a expense. Coming to depreciation, or it is also called amortization. You guys buy computers to be used in the home. Internet bills, internet bills are already in the ambit of part of those tax deductions which they give you for internet and telephone use and all those things. Depreciation is amortization, is a process of computing expense from allocating the cost of fixed asset over their economical useful life. Now, just to go back, if you, in a business, if you buy a motor car, like the earlier example I had, if you buy a motor car for 100,000, it is a fixed asset. That's for business. You're buying a motor car for your business use, it's 100,000. So what you cannot do is, you cannot take the 100,000 and charge it to your income statement as an expense, a one-time expense, because this is a fixed asset, which is a capital expenditure. This motor car is going to serve you for a period which will be called economical useful life. Typically, they use about 5 years as the life of the motor car on average. You might be driving the motor car for 20 years, irrespective, but the life of, typically they use a 5-year period. So what do is, they take the 100,000, divide it by 5. Every year to the P&L, they charge 20,000, 20,000, 20,000 as a business expense. Why? It is typically following the matching principle. That motor car is being used in your business to generate revenue over a period of 5 years. That's really the matching principle. Fixed assets will wear over time. That's why earlier we had some word called book value. What do you mean by book value? If you buy a motor car for 100,000 ringgit, the first year, the depreciation is 20,000 ringgit. You will charge 20,000 off to the profit and loss account. The value of your motor car will be called book value, which will be 80,000 ringgit. Subsequent year, again, it'll go down by 20,000. That's why it'll call book value. It is not the net realizable value. It is the book value as is recorded in the balance sheet. For example, here we have 4 notebooks. You bought these 4 notebooks for 20,000 ringgit. The useful life, you have taken an assumption is going to last you for 5 years, all right? Sometimes they use 3 years, because the way how fast technological advances are taking place, they usually keep the economical useful life 3 years, normally for computers and software, but I'm just using for this example 5 years. So what happens if you use a straight line depreciation method? You take the 20,000, divide it by 5 years. Every year you charge 4,000 as an expense to your P&L.
Zen from Anton and Chen has a question.
Sure.
Is the motor car that you talked about, does it have to be registered under the partnership? Because I don't think a motor car can be registered.
Why not? It is not a vehicle to be used in the business.
Because, sorry, but my question is that let's say if the car is registered under the partner's name.
No, it won't be allowed.
Right. So it has to be registered under the partnership.
Partnership. Yeah, it is. If it is an individual partner under the partner's name, no. The only thing which you can relate and collect certain things as deductible expense, if you go and provide toll tickets and mileage claims and whatever, petrol bills and whatnot, to the company to make a claim that this part of your, it is expenses deemed to have been incurred in terms to generate revenue. Maybe you're running up the court, the client or whatever, but anything to do with that particular asset, it is yours, unless it has been registered with the firm. So that's really depreciation, all right? This is how depreciation works. And at the end of the day, it is the rule of the game is it is a fixed asset. It cannot be charged to the P&L. It will be charged over a period of time by the way, something called depreciation or amortization. Same thing for patents and goodwills, which companies will record if they have patents and goodwill, which they bought a business at a higher price. They record it in the business accounts as called intangible assets. Goodwills or patents. So what they do with the patents and goodwill, they will probably amortize it over 20 years, a longer period, because those things will be charged over a longer period of time, patents and goodwill. So income statement, what goes into the income statement, just a recap, the money a business takes during the reporting period, what are the expenses you incur, and cost of goods sold, which is typically for companies who are selling products. And gross profit is the first line of profit, which you get the cost of making that product and the revenue you get in generating that the income. Then you have operating income coming in, all right, which is gross profit less all kind of operating expenses. Then you got your interest expense, and then you got income before income taxes. You will have to be paying taxes. After paying your taxes, you will have net income, which is normally called net profit. That's how it is. All right. It's all wordy here. The next slide, you'll have numbers. So that'll be a bit more easier to understand. This is the same thing, but the format falls in this way. You start from the top line. You know, everybody, the accountants have a very very fond of saying the top line of the company is this, the bottom line of the company is this. Top line of the company is the first line in your profit statement, which is your revenue or your sales. The bottom line of the company is your net profit, which is your net income. That's what bottom line and top line means.
How would disbursements recovered from clients be recorded?
Now, when you incur those disbursements, all right, you will be charging it in your expense line. And then what you do is you will have fees collected from your clients, all right, which will go into the fees line. And then there's a recovery of those disbursement, which will have to be going back to your expense line to reduce those expenses because you have recovered those expenses. So if, say, for instance, you got a if you got an expense, say, for instance, traveling, printing or whatever, say it's 100 ringgit, but you recovered from your client 80 ringgit or something like that. So you will take the 80 ringgit, knock it out against your actual expense of 100 ringgit, and you have a net expense of 20 ringgit if you're not recovering enough. All right, that's what happens, because it is not supposed to come as a fee. It is not fees. It is recovery of disbursement. So let's look at this income line. Huh? Assume I put a few numbers to it. Sales revenue is 800,000, and then you have cost of sales, the cost of making those products, 300. You less that, and this is where you come to something called gross profit. This is like the gross margin of the company. Then you less out all kind of expenses, sales and administrative expenses, all kind of operating expenses. Then you come to something called operating profit. Once you get your operating profit, there is further expenses to come by. Financing costs. What is financing cost? Is interest expense. You take loans from a bank, you pay for overdraft interest or whatever. You charge it as at this line here. Then you have something called pre-tax profit. After charging all these things, this is the amount of profit. This is the amount of profits which will be attracting tax. Assuming your tax is 20% for the purpose of this question, all right? So your pre-tax profit is 350,000. Assuming your tax rate is 20% on your pre-tax profit of 350, you have to have an income tax expense of 70,000. So your net profit after tax is 280,000. And then what happens is, this is in partnership, you don't have dividends, but in a company, they declare dividends. So whatever profits which comes after tax, which are typically, I think lawyers will know this name, distributable profits. Is it something familiar to you guys, right? No, it's distributable profits. So from the distributable profits, you will pay out your dividends. After paying out your dividends, you are left over still with profits. So what you will do with this profit, the word suggests retained profit, you will plow this profit back into the business. So this is a typical format of how a profit and loss account works. columns. From the right and from the top line, how it gets into the bottom line, which is your pre-tax profit, after-tax profit, and you pay your dividends and you got your retained profit. This is the format. Okay. So now you have this format. You guys have seen this. So what I want you to do quickly in 5 minutes, you should be able to do it. All right, have a paper and a pencil available beside you and a calculator. I have scrambled all this information up. This is some information of a particular company for the year ended 31st December 2020. They have an interest expense of 80,000. Cost of goods sold of 400,000, operating expenses of 200,000, revenue of 2 million, tax of 220,000. What I want you to do is put all this scrambled information into this format. I mean, this is no rocket science, guys. This is something you have done. Is just to follow the format, just to get the thing flowing to you is what goes first, what goes second, what goes third, or whatever. So what I do is I keep this format open here for you to view.
So what about bonuses? Do they come like after at the point of your profit after tax, or is that an expense that comes in earlier?
It is an expense. So what management accounts they do is usually they'll calculate all your profits. And then if you're under profit sharing situation, all right, you want to for your is it for your employee or the partners or who?
Either way.
Either way, normally in management account, they calculate what will be the profits of the company. From the profits of the company, they calculate what is the bonuses. Once they decide on the bonus will go up as an expense again. They will calculate it using management accounts to see what is the profitability of the company or your firm, and then calculate the bonuses. Once they calculate and say, this is the amount of bonuses which you are going to pay, they will charge it into the expense line, and then it comes, and then you calculate your tax after that. Okay, the rest of you guys, you got it, 1.1 mil? The whole intent down here is just to make sure that you understand what is your top line, what is your bottom line, what are the things comes in, and what is the sequence it goes. So nothing comes, your tax will be after charging all expenses. But in reality, this is for the purpose of this illustration, but in reality, when they calculate taxable profits, there are various other things to add and minus and all those things. That's a tax computation, which is a separate thing altogether. But just for simplicity's sake, this is how it goes.